Here's something most retirees don't understand until it's already cost them money. A 401k and an IRA look almost identical from the outside. They're both tax deferred, both funded with pre-tax dollars, both subject to required minimum distributions, both reported on Form 1099-R when money comes out. When a retiree walks into the HR office on their last day of work and signs the rollover paperwork, they assume they're just moving money from one bucket to a similar bucket. The balance transfers, the tax deferral continues, and life goes on. Except the rules that govern required minimum distributions change the moment that money crosses the line. What was a single simple RMD calculation inside your 401k becomes a more complex aggregated calculation across multiple IRAs. You can lose two valuable protections. You can accidentally miss a deadline and trigger a 50% excise tax under the old rule, or 25% under Secure 2.0. And the subtle shift in how the RMD is computed means your first post-rollover year often surprises you with a larger taxable distribution than you were expecting. Before we go further, the standard reminder: this video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. The rules I'm about to walk through come from IRS Publication 590B, the Secure Act of 2019, and Secure 2.0, which passed in late 2022 and has been phasing in provisions through 2026 and beyond. If your situation involves a recent rollover, the next few years matter a lot, and a 1-hour conversation with a qualified professional is worth more than any article or video you'll find online. Let's start with the protection you just lost. If you stayed employed past age 73 and kept your money inside your current employer's 401k, you qualified for something called the still working exception. As long as you weren't a 5% owner of the company, you could delay RMDs from that specific 401k until you actually retired. The money in that 401k wasn't subject to the age 73 trigger that applies to IRAs. But the minute you rolled that 401k to an IRA, the still working exception evaporated. IRAs never qualify for the still working exception, even if you're still working. Some retirees roll their 401k to an IRA while still employed, thinking they're consolidating for convenience, and they inadvertently trigger immediate RMD obligations on money that could have stayed protected until they actually retired. That's trap number one, and it catches more late career professionals than any other rollover mistake. Consider Thomas, a retired engineer from Columbus, Ohio, who kept working part-time as a consultant for his former employer. He was 74, and his old firm's 401k still had roughly $400,000 in it. He decided to consolidate everything into a single IRA for simplicity. His advisor processed the rollover, the money landed in the IRA, and 3 months later his custodian sent him a notice that an RMD was due by year-end on that entire $400,000 balance. The RMD came out to roughly $16,000 based on his age. If he had left the funds in the 401k while he continued his consulting work, he could have deferred that distribution for several more years. Instead, he owed roughly $3,520 of federal tax on an RMD he didn't have to trigger yet. He called the experience his most expensive clerical mistake. Here's the second complication. Inside a 401k, the RMD is calculated for that specific account, and you can only withdraw the RMD from that account. You can't take a 401k RMD out of another plan to satisfy it. But once money is in an IRA, the rules change dramatically. If you have multiple traditional IRAs, the RMDs for each are calculated separately, but you can aggregate the total and take the entire combined RMD from any one of them. This flexibility sounds convenient, but it creates a new trap. Retirees who have a mix of IRAs, SEP IRAs, and simple IRAs often assume aggregation works across all of these. It doesn't apply cleanly to inherited IRAs, which must be calculated and withdrawn separately, and it doesn't apply to Roth IRAs, which have no lifetime RMDs for the original owner under current law. Then there's trap number 3, and this one involves the calculation base itself. RMDs are calculated using the prior year's December 31st balance divided by a life expectancy factor from the IRS Uniform Lifetime Table. The year you roll a 401k to an IRA, the December 31st balance of your IRA just ballooned. Your first RMD calculation the following year is based on that inflated balance. If you rolled over $400,000 in mid-year and you already had an IRA with $200,000, your December 31st IRA balance is $600,000, and your next year's RMD is calculated on the full amount. This doesn't make your total RMD obligation larger over your lifetime, because the money was always going to come out eventually. But it changes the timing, which changes your bracket management, your IRMA exposure, and your Social Security taxability in the immediate post-rollover years. Linda, a retired school teacher from Lancaster, Pennsylvania, discovered this the hard way. She rolled her $320,000 403B from her school district into her existing IRA, the same year she turned 73. Her RMD that year, calculated on a combined balance of roughly $500,000, came out to just under $19,000. She had been expecting an RMD closer to $7,000 because her advisor had run numbers based only on her IRA before the rollover. The difference of $12,000 in taxable income pushed her into a higher Medicare RMA tier 2 years later. Her additional premiums totaled roughly $1,600 over the year the RMA tier applied. Combined with the federal tax on the unexpected RMD amount, she paid close to $3,700 more than she would have if the rollover had been timed or structured differently. Let me explain the structural option she missed because it matters. If you time a 401k to IRA rollover strategically, you can do it early in a calendar year, take the required RMD for that year from the 401k before the rollover, and then transfer the remaining balance to the IRA. And once the RMD has been satisfied, the money flowing into the IRA doesn't create a new RMD obligation in that same calendar year. The following year's RMD will then be calculated on the December 31st IRA balance, which you've at least had visibility into when planning. This is basic choreography, but it requires coordination between your HR department, your current 401k custodian, and your receiving IRA custodian. Most retirees leave it to chance and end up paying for the poor sequencing. Trap number 4 involves after-tax contributions. If your 401k contains after-tax dollars, and many older plans do, the rollover rules matter. You can split the after-tax portion into a Roth IRA tax-free while rolling the pre-tax portion into a traditional IRA. This isn't automatic. It requires specific paperwork and careful processing with the plan administrator. If you roll everything into a traditional IRA by default, the after-tax dollars mix with pre-tax dollars, and the basis tracking on Form 8606 becomes a permanent annual chore. Every future distribution from that IRA will carry a pro rata basis calculation, and if you lose the records or miscalculate, you can end up paying tax twice on the same dollars. Richard, a retired accountant from Allentown, Pennsylvania, had roughly $40,000 of after-tax contributions in his former employer's 401k from a decade of post-tax savings. He rolled everything into a traditional IRA without separating the after-tax portion. His basis tracking has been a source of annual friction ever since. His advisor now has to file Form 8606 every year, and the pro rata calculations shrink his after-tax benefit over time as his IRA balance grows. Trap number 5 involves the timing of notifications and the missed RMD penalty. If you miss an RMD entirely, whether from an IRA or a 401k, the IRS used to impose a 50% excise tax on the shortfall. Secure 2.0 reduced that to 25%, and in certain cases 10% if you self-correct within a specific window. You report the missed RMD on Form 5329 and calculate the excise tax from there. If you can show reasonable cause, you can request a waiver by attaching a statement. But the IRS doesn't automatically track whether you've taken your RMD from every account you own. That responsibility is yours. When your money is spread across multiple custodians, whether an old 401k, an IRA at one brokerage, and a simple IRA at another, the tracking burden grows fast. Many retirees who rolled 401k money to IRAs end up with more accounts to monitor, not fewer, because the rollover created a new account instead of consolidating into an existing one. Dorothy, a retired postal worker from Columbia, South Carolina, found herself with 4 separate retirement accounts after she rolled her 401k to an IRA at one brokerage, kept a smaller SEP IRA from a brief period of self-employment, and inherited an IRA from her late husband. Each account had its own RMD. The inherited IRA RMD couldn't be aggregated with her own. In her second year of juggling, she accidentally missed the inherited IRA RMD of roughly $6,200. She discovered the mistake in March of the following year when she was pulling documents for her tax return. Her preparer helped her calculate the excise tax on Form 5329, and she filed a waiver request showing reasonable cause. The IRS granted the waiver, but the process took 9 months and generated genuine stress she didn't need. Now let's talk about what you can do if you've already rolled over, because the decision is usually irreversible once the check is cleared. First, make a complete inventory of every retirement account you own, including the rollover IRA, any legacy IRAs, any old 401ks you haven't rolled yet, any simple or SEPI IRAs, any inherited IRAs, and any Roth accounts. For each one, note the custodian, the current balance, and whether it has an RMD obligation for the current year. Separately track inherited IRAs because their RMD rules are different and cannot be aggregated with your own. Second, establish a single coordinating point of contact. If you're working with an advisor, make sure they have visibility into all of your accounts, not just the ones held at their firm. If you're self-directed, consider building a single spreadsheet with each account, each December 31st balance, and each required distribution amount for the year. Review it in January, recalculate in February, and schedule distributions in the first quarter so you don't face a year-end scramble. Most RMD mistakes happen between October and December, when custodial processing delays collide with holiday schedules. Third, think about consolidation carefully. More accounts mean more tracking and more risk of error. Fewer accounts mean tighter tax planning and easier RMD execution. But consolidation is a permanent decision, and the still working exception I mentioned earlier, creditor protection differences between ERISA plans and IRAs, and the ability to use net unrealized appreciation on employer stock within a 401k, are all features you can lose in a rollover. If you hold appreciated company stock inside a 401k, the net unrealized appreciation treatment, known as NUA, can let you transfer the stock to a taxable brokerage account and pay ordinary income tax only on the cost basis, with the appreciation taxed at long-term capital gains rates when sold. This is one of the most valuable tax strategies that rollovers quietly destroy. If you roll the stock into an IRA, the NUA treatment is gone forever. Frank, a retired utility company worker from Topeka, Kansas, had $300,000 of appreciated company stock in his former employer's 401k. His original cost basis was only $42,000. If he rolled the stock into an IRA, he would eventually pay ordinary income tax on all $300,000 as it came out over his lifetime. Instead, his advisor walked him through the NUA strategy. He transferred the stock in kind to a taxable brokerage account and paid ordinary income tax on only the $42,000 basis in the year of the transfer. The $258,000 of appreciation is now taxed at long-term capital gains rates when he chooses to sell, which in his income bracket means 15% instead of 22%. The federal tax savings on that appreciation alone came to roughly $18,000, and he retained full control over the timing of sales. Most retirees with appreciated employer stock never hear about NUA until after they've rolled it into an IRA, at which point the door is closed. Another structural consideration involves Roth conversions in the low-income years between retirement and RMDs. If you retired at 65 and your RMDs don't begin until 73, you have 8 years where your taxable income may be unusually low. This is often the best window in your entire financial life to convert traditional IRA money to Roth. Each conversion moves dollars out of the future RMD calculation, reducing every future RMD permanently. It also moves dollars into an account that will never face RMDs during your lifetime under current law. The tax you pay today at a low bracket is often dramatically less than what you or your heirs would pay on those same dollars later. Helen, a retired nurse from Boise, Idaho, used this strategy. She retired at 66 with a large traditional IRA from a prior 401k rollover. For the 7 years between her retirement and her first RMD, her taxable income was low because she was living on Social Security plus modest withdrawals from her taxable brokerage. Her advisor mapped out annual Roth conversions of roughly $45,000 each year, filling up the 12% bracket but not spilling into 22. Over 7 years, she converted roughly $315,000 at an average federal rate of 11%. When her RMDs finally began, they were calculated on a smaller traditional IRA balance, which reduced her annual RMD by approximately $13,000 per year. Over her 20-year retirement, the cumulative tax savings were approaching $70,000, and her Roth balance continues to grow tax-free for both her use and eventual transfer to her daughters. Let me walk through one more trap, because it affects married couples specifically. If your spouse is younger than you by more than 10 years, your RMD calculation can use the joint life and last survivor expectancy table instead of the uniform lifetime table. This table produces smaller RMDs because it assumes a longer combined life expectancy. Most retirees and many advisors default to the uniform lifetime table without checking whether the joint table applies. If you qualify, switching saves you real money every year. The reverse isn't available. If you're younger than your spouse by 10 years, you still use the standard table. Arthur, a retired truck driver from Reno, Nevada, was married to Joyce, who was 14 years younger. His original custodian calculated his RMD using the uniform lifetime table for 3 years before a new advisor caught the mistake. The difference in distribution factor meant his RMD had been roughly $2,000 higher each year than it needed to be. Over 3 years, he had paid federal tax on $6,000 extra dollars of unnecessary distribution. The advisor filed amended returns using Form 1040X for the 2 years, still open under the statute of limitations, and recovered approximately $1,300 in refunds. The third year was outside the statute and couldn't be recovered. Paying attention to which table applies is a tiny detail that compounds across a multi-decade retirement. Here's the underlying truth most retirees never fully grasp. A 401k and an IRA are not the same thing. They occupy different legal categories under ERISA and the Internal Revenue Code. They have different RMD rules, different creditor protections, different rollover mechanics, different beneficiary provisions, and different planning opportunities. The rollover you signed on your last day of work was a genuine choice with genuine trade-offs, not a neutral paperwork transfer. If the decision was made under pressure or without running the full set of implications, it's worth revisiting with a fresh advisor who will walk through each dimension with you. You can't undo a rollover, but you can correct course on how the money is managed, taxed, and distributed going forward. If you want to take action after this video, start by pulling every retirement account statement you currently hold. List them out. Identify which came from rollovers and which are original IRAs or 401ks. Note the balances. Note whether RMDs apply. Bring that list to a qualified professional and ask 3 questions. Am I using the correct RMD table? Am I properly tracking basis on any after-tax portions? And would a Roth conversion strategy between now and my first RMD year reduce my lifetime tax burden? Those 3 questions alone will surface most of the issues we've covered today. If you want more protective expert walkthroughs like this one, hit subscribe and stay close. Retirement planning isn't about one big decision. It's about a dozen small decisions that each compound over time, and the quiet ones are usually worth the most.